Section 1. The big question. Africa's next growth engine. If you walk into any room full of investors and ask them where the next global growth story is, their eyes will eventually land on Africa. It's the final frontier, a continent bursting with youth energy and a relentless entrepreneurial spirit. For decades, the narrative has been about Africa rising, a story of potential waiting to be unlocked. But today, that potential is not just a vague promise. It's a tangible reality playing out in real time. The question is no longer if Africa will rise, but where on the continent the most explosive growth will happen next. It's a debate that dominates boardrooms from London, Lagos, New York, Nairobi. Everyone wants a piece of the action, but placing the right bet is everything. Drill down a little deeper, and the conversation quickly narrows. The continent is vast, but two regions consistently emerge as the frontrunners in this high-stakes race. On one side, you have East Africa, steady growth, political stability, innovative spirit. On the other, you have West Africa, population culture, raw economic might. Both regions are compelling. Both are magnets for capital and talent, and both are filled with contradictions. Pockets of incredible wealth next to immense challenges. They represent two different visions for Africa's economic future, and investors are trying to figure out which vision will deliver the biggest returns over the next decade. This isn't just an academic debate. For entrepreneurs on the ground, choosing where to build a company can be the difference between success and failure. For investors, allocating capital to the right ecosystem could generate returns that are simply impossible anywhere else in the world. The stakes are incredibly high. So, which region truly holds the crown? Which one offers the most robust and sustainable trajectory for business growth? Is it the disciplined and orderly rise of the East, or the chaotic, high-octane energy of the West? It's the ultimate showdown, a friendly but fierce rivalry for the title of Africa's premier business destination. Today, we are going to settle this debate once and for all. We're not relying on hype or headlines. Instead, we're doing a deep dive, a head-to-head comparison across the metrics that truly matter. We will analyze everything from raw economic performance, startup ecosystems, ease of doing business, flow of investment capital. We will look at consumer markets, infrastructure, Fintech, climate tech, agriculture. By the end of this analysis, you will have a clear picture of each region's strengths and weaknesses, helping you understand where the real opportunities lie right now. Get ready, because the battle for Africa's economic future starts now. Section 2, a tale of two titans. Let's begin by setting the stage. West Africa is a giant, home to over 420 million people. It's anchored by Nigeria, the continent's most populous nation and largest economy. This region is a whirlwind of activity, a massive consumer market. Fortunes can be made overnight. Think of the vibrant streets of Lagos, the bustling ports of Abidjan, the thriving markets of Accra. West Africa is defined by its scale, people, transactions, opportunities. This is the region that produced some of Africa's first billion-dollar startups, particularly in the financial technology space. It's loud, it's ambitious. It moves at a pace that can be both exhilarating and overwhelming. In the other corner, we have East Africa, with a population of over 300 million people. But its story is different. Kenya, Rwanda, Ethiopia, Tanzania built a reputation for consistency. For more than a decade, this bloc has posted stable, impressive GDP growth rates, forward-thinking policies, investments in digital infrastructure, efforts to create a predictable, business-friendly environment. East Africa is where innovation focuses on solving fundamental problems in agriculture, energy, logistics. So you have two very different contenders. West Africa offers unmatched market size, a proven track record of creating high-growth, venture-backed companies, especially in Fintech. If you want to build a business that can reach 100 million customers, this is your playground. The potential for explosive hockey stick growth is undeniable. However, this scale comes with significant challenges, navigating complex bureaucracies, dealing with currency volatility, overcoming infrastructure gaps. It's a high-risk, high-reward environment, demands resilience and a deep understanding of its intricate markets. It is not for the faint of heart. East Africa, by contrast, presents a more calculated bet. It's the region of disciplined innovation. Startups here are often celebrated not for their valuation, but for their impact and sustainability. Think of Kenya's world-leading adoption of mobile money, or Rwanda's rise as a hub for governance and technology. This region attracts a different kind of investor, focused on long-term value, climate solutions, building essential infrastructure for modern economies. The path to scaling might be more gradual, but the foundation is arguably more solid. The question is, which of these models will prove more powerful in shaping the decade to come? Table of Contents, Part 2, Act 1. The Economic Scorecard, about 3 sections. Section 1. The GDP growth race, stability versus volatility. When you look at the raw economic data, a fascinating picture emerges. It's the story of the tortoise and the hare, but with a continental twist. For over a decade, East Africa has quietly but consistently outpaced the rest of the continent in GDP growth. This isn't a fluke, it's a trend. Rwanda, Ethiopia, Kenya, Tanzania, Uganda. They have managed to maintain impressive annual growth rates, often hovering between 5 and 7%. This performance is even more remarkable when you consider the global shocks they've weathered, from commodity price slumps to the recent pandemic. They just keep chugging along. This steady expansion is built on a foundation of deliberate economic planning and diversification. Take Rwanda, for example, which has transformed itself into a hub for technology and services through disciplined governance, or Ethiopia, which has been making a monumental push into industrial manufacturing, aiming to become the factory of Africa. Kenya, the region's economic anchor, continues to leverage its advanced service sector and role as a logistics hub. This isn't growth driven by a single commodity boom. It's a more balanced and therefore more sustainable model. For any investor or entrepreneur who values predictability, East Africa's economic report card is incredibly reassuring. It signals a stable environment where long-term plans can be made with a degree of confidence. Now, let's turn our attention to West Africa. The story here is one of immense potential mixed with significant volatility. The region is home to economic powerhouses, but their performance is far more of a roller coaster ride. Côte d'Ivoire, Senegal. Driven by agricultural exports and infrastructure investment. Ghana, another key player, has shown periods of rapid expansion, becoming a magnet for foreign direct investment. However, the region's overall economic narrative is dominated by its largest player, Nigeria, and Nigeria's journey is anything but smooth. Its dependency on oil prices creates a boom and bust cycle that sends shockwaves across the entire region. This volatility makes long-term economic forecasting in West Africa a much trickier business. One year, the economy might be booming, fueled by high oil prices and consumer spending. The next, a currency devaluation or a dip in commodity markets can erase those gains. This creates a challenging environment for businesses that require stability to grow. While the sheer size of the market is a powerful lure, the underlying economic instability can be a major deterrent. It forces companies to operate in a constant state of adaptation, navigating unpredictable policy shifts and macroeconomic headwinds. The growth is there, but it comes with a much higher dose of risk and uncertainty. Section 2. The scale factor. Big markets, big problems. The single biggest argument in West Africa's favor is its colossal scale. With over 420 million people, it represents one of the largest and youngest consumer markets on the planet. Nigeria alone has a population exceeding 200 million people. That's more than the combined populations of Germany, France, and the United Kingdom. This isn't just a number. It's a market of incredible depth and dynamism. For any business selling consumer goods, financial services, or digital products, the addressable market is simply massive. If you can capture even a tiny fraction of the Nigerian market, you can build a very large company very quickly. This is the promise that has drawn so many entrepreneurs and investors to cities like Lagos. This scale creates a powerful gravitational pull. It fosters intense competition, which in turn drives innovation, especially in sectors that cater directly to the mass market. The Fintech revolution in Nigeria, for instance, wasn't just a coincidence. It was a direct response to the needs of a population that was huge, young, and largely underbanked. The sheer volume of transactions creates a fertile ground for payments, lending, and digital banking platforms to achieve a scale that is difficult to replicate in smaller markets. West Africa's size means that if you have a product with mass appeal, the potential for exponential growth is unparalleled on the continent. It's a go big or go home environment. However, this massive scale comes with equally massive challenges. Servicing a market of 420 million people spread across multiple countries is a logistical nightmare. Infrastructure, while improving, remains a significant bottleneck. Roads can be congested, ports can be slow, and the power supply is notoriously unreliable in many urban centers. These issues add significant operational costs and complexity for businesses. A company might have a fantastic product, but if it can't get it to its customers reliably or affordably, the size of the market becomes irrelevant. The scale that is so attractive on paper can become a crushing operational burden in practice. In contrast, East Africa's markets, while smaller, are often more integrated and easier to navigate. The East African community has made significant strides in harmonizing trade policies and developing regional infrastructure corridors, like the Northern Corridor connecting Kenya to its landlocked neighbors. This makes it easier for a business based in Nairobi to expand into Uganda, Rwanda. While the total population might be smaller, the effective accessible market can feel more manageable. The challenges are still there, of course, but they are often on a different level. In East Africa, the problem might be last-mile delivery. In West Africa, it might be getting a container cleared at the port for 3 weeks. Section 3. Economic undercurrents, inflation, and currency woes. Beyond the headline GDP numbers, we have to look at the economic undercurrents that shape the daily reality of doing business. Here, the differences between the two regions become even sharper. One of the most significant challenges plaguing several West African economies, most notably Nigeria, is chronic high inflation and currency instability. When your local currency can lose 30 or 40% of its value against the dollar in a single year, it creates chaos. For businesses that rely on imported goods, raw materials, or foreign software, this volatility can wipe out profit margins overnight. It makes financial planning a guessing game and discourages long-term investment. This currency risk is a huge factor for international investors. If they invest in a Nigerian startup in US dollars, a sharp devaluation of the naira means their stake is suddenly worth much less in dollar terms. Furthermore, getting foreign currency out of the country can be a bureaucratic ordeal, with central bank restrictions creating long delays. This forex risk is a major headache and a significant barrier to entry. It forces businesses to become experts in currency hedging and financial engineering, distracting them from their core mission of building products and serving customers. It's a tax on growth that companies in more stable environments simply don't have to pay. East Africa, for the most part, has managed these macroeconomic risks more effectively. While countries like Kenya and Uganda also face inflationary pressures, they have generally been more moderate and predictable. Their central banks have often been more successful in maintaining currency stability, providing a more reliable operating environment. The Kenyan shilling, for example, has been far less volatile than the Nigerian naira. This stability is a powerful, if underrated, competitive advantage. It allows businesses to plan for the future, to price their products with confidence, and to attract foreign capital without the massive discount that currency risk demands. It lowers the cost of doing business in a fundamental way. Ultimately, this economic stability translates into a lower risk environment. While the potential rewards in West Africa might seem higher due to its market size, the risks are proportionally greater. An entrepreneur in Lagos might have a bigger potential customer base, but they also have to worry about whether they can pay their international suppliers next month. An entrepreneur in Nairobi might be targeting a smaller market initially, but they can focus more of their energy on execution, knowing that the macroeconomic ground beneath their feet is less likely to shift dramatically. On the economic scorecard, if stability is your primary metric, East Africa has a clear and decisive edge. Table of Contents, Part 3, Act 2, The Startup Landscape, about 3 sections. 1. The Density Debate, Volume versus 2, Where the Money Flows, Venture Scale versus 3, The Unicorn Race, Fintech Giants versus, Section 1. The Density Debate, Volume versus. When you map out Africa's startup ecosystem, West Africa is the continent's undisputed heavyweight champion in terms of sheer numbers. It's a numbers game, powered almost single-handedly by Nigeria. Lagos is not just a city, it's a startup factory. It churns out new companies at a dizzying pace, estimates suggesting Nigeria alone is home to more than 1/3 of all startups on the continent. This incredible density creates a hyper-competitive, high-energy environment. It's a place where ideas are born, tested, and fail in rapid succession. There's always something happening, a new company making headlines, a new founder with a bold new pitch. This massive concentration of startups creates a powerful network effect. The ecosystem feeds on itself. You have a deep talent pool of developers, marketers, product managers. You have a community of founders who can share war stories, advice, and connections. This creates a virtuous cycle where success breeds more success. Lagos, Accra. You are constantly surrounded by ambition. It's an environment that pushes you to move faster, think bigger, and compete harder. For anyone looking to dive into the deep end of the African tech scene, West Africa offers an unparalleled level of activity and energy. Now, let's pivot to East Africa. The scene here is different. It's less about frantic volume and more about measured velocity, led by hubs in Nairobi, Kigali, and Kampala. The East African startup landscape is smaller, but many would argue it's more disciplined. Instead of 1,000 flowers blooming in every direction, the focus here seems to be on cultivating fewer but stronger plants. Founders in this region are often praised for building sustainable business models from day one. There's less emphasis on the growth at all costs mentality and more focus on achieving profitability and solving fundamental real-world problems. It's a culture of building to last, not just building to flip. This approach results in a different kind of startup ecosystem. While there might be fewer companies, the quality is often remarkably high. Startups methodically tackling deep-seated challenges in agriculture, clean energy, healthcare, and logistics. These aren't just app-based solutions looking for a quick exit. They are complex operations designed to integrate with the real economy. The ecosystem in East Africa is characterized by a sense of purpose and pragmatism. It's less about hype and more about impact. For founders and investors who prioritize strong fundamentals and long-term viability over explosive, headline-grabbing growth, the disciplined nature of the East African landscape is incredibly appealing. It's a different philosophy for building the future. That's the gist. Section 2, where the money flows, venture scale versus impact capital. Funding is the fuel that powers the startup engine, and where that fuel comes from tells you a lot about an ecosystem's priorities. West Africa, and again, primarily Nigeria, has become the darling of traditional venture capital. The region consistently attracts the lion's share of equity funding pouring into the continent. Why? Because VCs are chasing scale, and West Africa offers the clearest path to building a billion-dollar company, a unicorn. The massive market size, combined with the proven success of its fintech sector, creates a compelling story for investors looking for those rare 100 times returns. They see a market of 420 million people and dream of capturing it. This influx of venture capital has a profound effect on the ecosystem. It creates a culture of ambition where founders are encouraged to think big and raise large rounds of funding to grow as fast as possible. The money flows predominantly into sectors with a clear path to monetization and scale, which is why fintech has become so dominant. Paystack, Flutterwave, InterSwitch. They are now actively searching for the next big thing in payments, lending, or digital banking. Consequently, if you are a fintech founder with a scalable model, West Africa is the best place on the continent to raise capital. East Africa, on the other hand, attracts a different kind of money. While venture capital is certainly present and growing, the region is the undisputed leader in attracting impact capital. These are investors who are looking for both a financial return and a measurable social or environmental benefit. They are drawn to East Africa's reputation for practical innovation in sectors that matter deeply for sustainable development. Clean energy, where pay-as-you-go solar companies have transformed energy access. Agriculture, where agritech platforms are connecting smallholder farmers to markets. And mobility, where electric vehicle startups are tackling urban pollution. It's a different investment thesis, focused on building resilient economies. This focus on impact and blended finance, a mix of grants, debt, and equity, shapes the startup landscape in a unique way. Grants, debt, equity. It allows companies to tackle complex, systemic problems that might not offer the quick, explosive returns that traditional VCs demand. It provides patient capital for businesses that need time to build out physical infrastructure or change long-standing behaviors. Startups in East Africa are often built with a double bottom line in mind from the very beginning. This doesn't mean they aren't commercially viable. In fact, many are highly profitable. It just means their definition of success is broader. If your goal is to build a company that solves a major societal challenge, East Africa's funding ecosystem is tailor-made for you. Yeah. Section 3, the unicorn race. Fintech giants versus real economy champions. The unicorn, a private startup valued at over $1 billion, has become the ultimate symbol of tech success. In Africa, the unicorn race has been dominated by West Africa. Nigeria, in particular, has been a breeding ground for these mythical creatures. Flutterwave, InterSwitch, building the digital payment rails for the region's enormous economy. They process billions of dollars in transactions, proving you can build a global-scale tech company from Lagos. The fintech giants are the poster children for the West African startup dream. Find a huge problem in a massive market. Build a scalable solution. Conquer the continent. Their success sends a powerful signal to the world. It tells investors West Africa can create immense value. It inspires founders and attracts international talent and capital. The ecosystem focuses on finding the next fintech winner. Highly concentrated, incredibly dynamic. These companies are becoming pillars of regional economic infrastructure. They are the giants on whose shoulders the next wave of innovation will be built. East Africa's story is different. Real economy champions. Impact on the ground, not headline valuations. M-Kopa, Kenyan pioneer of pay-as-you-go solar. Solar home systems powering households. Financing for smartphones. Financing for other essential assets. Millions of households gain power and connectivity. profitable and sustainable business models, innovation you can see and touch, tackling stubborn challenges on the ground, electric motorcycle networks reducing costs and pollution, agricultural startups using mobile tech and data science, providing financing, providing market access, complex tech-enabled operations that integrate with the physical world, less hype than fintech, but huge value creation, building foundational companies for a resilient, inclusive, sustainable economy. You don't need $1 billion valuation to be a winner. Section 1. The bureaucracy battle, red tape versus red carpet. Let's talk about something every entrepreneur dreads: paperwork. The soul-crushing, time-wasting, will-to-live draining process of government bureaucracy, where the dream of building a business meets the harsh reality of red tape. There's a clear and widening gap between East and West Africa. East Africa has been rolling out the red carpet for businesses. Kenya, Rwanda. They invested in digitizing government services, a game changer. Imagine registering a business online in hours, not weeks. In Rwanda, that's the reality. Rwanda, streamlined, top rankings for ease of doing business. Kenya, e-citizen portal centralizes services. Show options, register a business. Show options, apply for a permit. Tanzania has also made big strides. Digital first means transparency and predictability. It reduces opportunities for corruption. It makes the rules clear for everyone. Now, cross to West Africa. The picture is more complicated. Bright spots exist: Ghana, Côte d'Ivoire, Senegal. They're copying what works and catching up fast. Momentum in cities like Abidjan, a real desire to ease business operations. But Nigeria presents a tougher challenge. Bureaucracy there can feel like a full-contact sport. Opaque regulations, long delays, facilitation payments, registering a company, clearing goods from the port, securing a permit. For a small startup, these burdens can be crippling. A stark contrast to the slick digitized East. Nigeria's market size is a huge draw, but daily friction is a significant operational tax. Section 2. The infrastructure showdown. Corridors versus congestion. Great, so you've registered your business. Now you actually have to build it. You need to move goods. You need to connect to the internet. You need to keep the lights on. This brings us to infrastructure, the physical backbone of any economy. The two regions present very different propositions. East Africa has been strategic and ambitious in building modern, integrated infrastructure. The Northern Corridor is a standout example. Roads, railways, pipelines. It links the port of Mombasa to landlocked neighbors, Uganda, Rwanda, South Sudan. This isn't just a road, it's an economic lifeline. Regional connectivity makes East Africa act more like a single market. A company in Nairobi can more easily reach customers in Kampala. Kenya's undersea fiber investments have turned Nairobi into a tech hub. Fast, affordable internet. Ethiopia is pushing industrial parks and renewable energy. Hydropower to power manufacturing. Long-term bets, and they're paying off. West Africa. Big assets, bigger bottlenecks. Some of the continent's busiest seaports. Port of Lagos, Port of Abidjan. These ports are global trade gateways. The region also has massive consumer hubs and dense cities. But connecting ports to cities is often slow and painful. Traffic jams, logistical hurdles that can add weeks to shipments. Then there's the power problem. Electricity is inconsistent in major West African markets. Businesses, from small shops to large factories, rely on diesel generators. Generator economy, expensive, polluting, and draining. Investments are underway, but the current reality is congestion and intermittent power. The infrastructure exists, but it's often stretched to breaking point, creating a high-cost operating environment. That stands in stark contrast to the more coordinated build-out in the East. Section 3, the policy gamble, predictability versus surprises. Finally, let's talk about the rules of the game. It's one thing to have good infrastructure and low bureaucracy, but if the government keeps changing the rules, it's impossible to play. This is the issue of policy predictability, and it may be the single most important factor for long-term investors. East Africa has worked hard to build a reputation for stability. Kenya, consistent pro-business policies over time. Rwanda, consistent pro-business policies over time. Investors need to know that the tax laws, import duties, and regulatory frameworks won't change overnight. This sense of predictability fosters trust. It encourages businesses to make long-term capital investments, building a factory, developing a farm, because they have confidence that their investment won't be undermined by a sudden policy shift. Rwanda, aiming to be a hub for financial services. Kenya, committing to a green energy transition. They tend to stick with the plan. This doesn't mean there are no surprises, but the general direction of policy is clear and consistent. For any business leader answering to a board of directors, this predictability is golden. It allows you to build a 5 or 10-year plan with reasonable certainty. West Africa, on the other hand, can feel like a policy gamble. The environment is far more dynamic, and that dynamism extends to government policy. Nigeria is known for sudden and often unpredictable policy shifts. One day, the border might be closed to certain imports. The next, the central bank might restrict access to foreign currency. These decisions often come with little warning, leaving businesses scrambling to adapt. While intended to address economic challenges, unpredictability creates a climate of uncertainty that can be toxic for business. Policy volatility is a major risk factor. It can turn a profitable model into an unviable one in the blink of an eye. Example, a company relying on imported raw materials could see its supply chain disrupted. Example, a tech startup needing international software services could be unable to access US dollars. This forces companies to be incredibly agile and politically savvy, but it distracts them from their core business. On the ease of doing business scorecard, predictability is a massive advantage. And on that metric, East Africa is playing a different and much safer game. Section 1. Fintech, the West African money machine. When it comes to fintech, this isn't even a fair fight. It's a knockout. West Africa, we're mostly talking about Nigeria, is the undisputed continental champion. This region has truly cracked the code on digital payments, lending, and banking at scale. Why? Because the combination of a massive population, a young population, and a digitally savvy population with a historically underserved banking sector created the perfect storm. The big banks weren't serving the people, so a new generation of founders stepped in and decided to build the financial system themselves, from the ground up. It was a revolution, and it was televised on millions of smartphone screens. The results are staggering. West African companies have built the foundational rails for Africa's digital economy. Logos Montage, Paystack or Flutterwave, or OPay over a busy Lagos street. Paystack, acquired by Stripe for over $200 million. Flutterwave, a unicorn valued at over $3 billion. They made it possible for any business, big or small, to accept payments online from anywhere in the world. They solved a massive problem and unlocked a whole new wave of commerce. These aren't just apps, they are critical infrastructure. They are the digital roads and bridges that the entire ecosystem is now being built upon. It's a level of dominance that is simply unmatched. This fintech dominance creates a powerful flywheel effect. The success of the first wave of payment companies has inspired a second wave: digital banking for small businesses, micro-lending for market traders, cross-border transfers for the diaspora. The talent pool is deep, with developers and product managers who have experience building financial products for millions of users. And the investors are paying close attention, pouring hundreds of millions of dollars into the sector. The entire ecosystem is geared towards financial innovation. While East Africa has its own fintech story, particularly with the pioneering success of M-Pesa in Kenya, it plays a different game. M-Pesa revolutionized mobile money and financial inclusion for individuals, but it didn't create the same kind of B2B infrastructure layer for online commerce that exploded in West Africa. Energy, capital, sheer number of startups focused on building the future of finance, all concentrated in the West. So, on the scorecard for Fintech, the winner is clear. West Africa doesn't just lead, it completely owns this sector. It's the region's crown jewel, and for good reason. Section 2, Climate, Energy, and Agriculture, the East African Green Revolution. Now, let's switch gears. If West Africa owns the digital wallet, then East Africa owns the ground beneath our feet. Climate tech, clean energy, agriculture. This isn't an accident. It's the result of a deliberate focus on solving real-world problems. East Africa has become a global laboratory for a green, resilient economy. Pragmatism, purpose, and incredible ingenuity. And it starts with how the region keeps its lights on. Take clean energy. Kenya is a world leader, with over 90% of its electricity coming from renewables. Geothermal, hydro, wind. That government-led push has created fertile ground for private sector innovation. East Africa is the birthplace of the pay-as-you-go solar industry. Companies like M-Kopa and D-Light. Now, this innovation is moving into e-mobility. Startups in Nairobi, startups in Kigali, building networks of electric motorcycles and battery swapping stations. This is climate action as a business model. The region is writing the playbook for the rest of the world. This connection to the real economy is even more pronounced in agriculture. Agriculture is the biggest employer in both regions. But East Africa has taken a decisive lead in agritech. Startups in Kenya, startups in Uganda, startups in Tanzania. Companies providing smallholder farmers with high-quality seeds and financing through their mobile phones. Platforms using data science and satellite imagery to provide weather forecasts and farming advice. Innovative logistics companies are building cold chains to reduce post-harvest losses and connect farmers directly to markets, cutting out exploitative middlemen. These are not pie-in-the-sky ideas. These are businesses improving livelihoods and making the food system more efficient and resilient. They attract a different kind of capital, impact investors and development finance institutions. While West Africa has a massive agricultural sector, it hasn't seen the same explosion of tech-enabled innovation. In East Africa, the fusion of technology with the oldest industry in the world is creating a quiet but powerful green revolution. For climate, energy, and agritech, East Africa holds the undisputed title. Section 3, Commerce and Logistics. Now we come to a fascinating head-to-head battle: commerce and logistics. This is where you move things and sell things, the lifeblood of any economy. And here, the verdict isn't so clear-cut. It's a tie, but for very different reasons. West Africa wins on the sheer, raw, unapologetic scale of commerce. The numbers are just mind-boggling. Lagos, Accra, Abidjan. The informal markets are ecosystems unto themselves, with billions of dollars in goods changing hands every single day. The consumer appetite is enormous. Food, beverages, fashion, fast-moving consumer goods. This massive consumption base makes West Africa the ultimate prize for any retail or e-commerce player. If you want to sell a high volume of products, this is where you need to be. Companies that can figure out how to tap into this massive river of commerce can build empires. Formal, informal. The challenge, of course, is logistics. Getting your product from the port to the warehouse to the final customer is a Herculean task, battling congestion, poor roads, and a fragmented network of providers. The opportunity is huge, but so is the headache. East Africa's strength is the mirror image of West Africa's. The consumer market, while growing fast, is smaller. Northern Corridor. Standard gauge railway. The logistics landscape is more organized and increasingly more sophisticated. In Kenya, You are seeing the rise of modern, tech-enabled logistics platforms that are professionalizing the industry. Warehousing, last-mile delivery. You can serve a multi-country region from a central hub like Nairobi with more predictability. So you have a classic trade-off. West Africa offers a massive, concentrated pool of demand, but you have to fight through a logistical jungle to reach it. East Africa offers a smoother, more efficient path to market, but the market itself is more spread out and smaller in total volume. Both regions present massive opportunities in commerce and logistics, but they demand completely different strategies. It's a true tie. Table of Contents, Part 6, Act 5, Consumers and Capital, about 3 section. 1. Population power. Numbers versus the middle class. 2. The spending story. What's in the shopping cart? 3. Following the money equity versus impact. Section 1. Population power. Let's start with the most basic metric of all, people. When it comes to sheer population power, West Africa is an absolute juggernaut. We're talking over 420 million people. That's more than the entire population of the United States. Nigeria alone is a nation of over 200 million. This isn't just a demographic statistic, it's a market force of nature. For any company selling a product or service, these numbers represent an ocean of potential customers. The scale is so vast that even capturing a tiny fraction of this market can lead to enormous success. It's the kind of scale that makes global brands sit up and pay very close attention. This population is not just large, it's also incredibly young. The median age in a country like Nigeria is around 18. This creates a dynamic, fast-moving consumer culture. Hungry for new products, hungry for new technologies, hungry for new experiences. It's a market that is constantly reinventing itself. If your business model relies on volume, on selling a lot of units to a lot of people, then West Africa is, without a doubt, your target. The numbers are simply too big to ignore. It is the continent's undisputed demographic heavyweight champion. Now, let's look at East Africa. With a population of over 300 million, it's certainly no small fry. But its consumer story is a little different. It's less about the raw numbers and more about the changing shape of the market. East Africa is distinguished by the rapid growth of a stable, digitally connected middle class. This is a segment with increasing disposable income and a growing appetite for quality goods and services. They are not just surviving, they are building careers, buying homes, investing in their families' futures. This creates a different kind of consumer demand. This emerging middle class is also defined by its digital fluency, thanks to early and deep penetration of mobile technology. Consumers in countries like Kenya are incredibly comfortable with digital services. They were paying bills on their phones, sending money on their phones, accessing services on their phones. This creates a more sophisticated consumer base, ready to adopt new digital products that offer convenience and value. So while West Africa has the staggering numbers, East Africa boasts a more concentrated, arguably more advanced, middle-income consumer segment, driving a different kind of growth. Section 2. The spending story. So, we have these two massive consumer blocks, but what are they actually spending their money on? The answer reveals a lot about their economies and the biggest opportunities within them. In West Africa, consumer spending is heavily concentrated on the absolute essentials: food, beverages. With such a massive population, just feeding everyone is a multi-billion-dollar industry. Telecommunications, airtime, data, financial services, fees associated with moving money. This is mass market spending at its most fundamental level. This spending behavior tells you where the biggest prizes are. If you can innovate in the food supply chain, you have a market of 420 million mouths to feed. If you can provide cheaper and more efficient communication, or financial services, you are tapping into a daily need for a huge swath of the population. The spending is frequent, it's essential, and it's driven by the necessities of life. This is why Fintech and companies in the fast-moving consumer goods sector have found such fertile ground in West Africa. They are serving the core, non-negotiable needs of a massive and growing consumer base. In East Africa, the spending story has a slightly different flavor. While food and essentials are still dominant, you see a more diverse and consistent spending pattern on life-enabling services. Mobile money is at the heart of everything. East African consumers use platforms like M-Pesa not just to send money, but for a whole suite of daily transactions: paying utility bills, buying groceries, paying for transport. This creates a powerful ecosystem for repeat purchase services. It's a habit, a daily ritual that has been ingrained in the culture for over a decade, creating incredible customer loyalty. Beyond mobile money, you see consistent spending on solutions that improve daily life. This includes paying small daily installments for a pay-as-you-go solar home system, which provides clean light and power. It includes paying for rides on a boda, a sector being rapidly transformed by mobility apps. And it includes paying for daily utilities and services, often through digital platforms. The key insight here is the power of the repeat purchase model. East African consumers are accustomed to subscription-like payments for essential services. If your business is built on recurring revenue, the behavioral patterns in East Africa provide a very strong foundation for growth. Section 3. Following the money. Equity versus impact. Finally, let's look at where the smart money is going. Investment inflows are a powerful indicator of where global capital sees the most future potential. And once again, we see a clear divergence between the two regions, reflecting their unique strengths. West Africa is the undisputed king of venture capital equity funding. When big-name VCs from Silicon Valley, Europe, Asia, look at Africa, their first stop is often Lagos. They are writing the big checks, the multi-million-dollar Series A, Series B, Series C rounds, chasing the continent's next unicorn. The money is flowing, and it's flowing into scalable tech. As we've seen, this equity funding is heavily skewed towards fintech. Investors see a proven model and a massive market, and they want a piece of the action. This creates a high-stakes, high-growth environment where companies are capitalized to scale aggressively. But what does this mean for the future? As investors look for the next big thing beyond payments, e-commerce, logistics, health tech, sectors that can also leverage the region's massive scale. West Africa's investment story is about firepower. It's about concentrating capital to create massive category-defining companies. East Africa's investment landscape, while also growing, tells a different story. The region is the global leader in attracting impact capital, climate finance, and blended finance structures. These are investors who are not just chasing a financial return. They are also looking to fund solutions to major global challenges. This includes capital from development finance institutions, specialized climate funds, and philanthropic foundations that use grants and patient debt to de-risk investments for the private sector. This unique funding mix allows East African companies to tackle problems that traditional VC might find too risky or too slow to pay off. So, which region is better positioned for future investment? Well, let's look at the global trends. The world's biggest investors are increasingly prioritizing climate adaptation, renewable energy, food security, and sustainable infrastructure. These are the exact sectors where East Africa has built a world-class innovation ecosystem. While West Africa will continue to dominate in fintech equity, the next decade's surge of global capital is likely to be green. This positions East Africa to attract a massive new wave of investment focused on building the resilient, sustainable economies of the future. The smart money is getting greener, and that gives East Africa a powerful, long-term advantage. Section 1. The final verdict. All right, we have crunched the numbers. compared the ecosystems, and analyzed the capital. We've looked at everything from GDP growth, startup density, bureaucracy, and consumer spending. After all of this, it's time to answer the big question we started with. Which region, East Africa or West Africa, has the strongest business growth trajectory for the next decade? It's the final showdown, the moment of truth. And the answer, like Africa itself, is more complex and interesting than a simple headline, because it all depends on how you define winning. It's not about one being good and the other being bad. It's about two different paths to success. Let's break it down. If your definition of the strongest business growth is all about stability, East Africa takes the lead. Stability, resilience, and building for the long haul. This is the region of consistent GDP growth, predictable policy, and an environment that makes it easier to actually get things done. It's where innovation is focused on solving fundamental, real-world problems in agriculture, climate, and energy. If you want to build a sustainable company with strong fundamentals, a business that solves a deep societal need, and is supported by a growing, digitally savvy middle class, East Africa offers you a more solid foundation. It is the marathon runner, building steady momentum for the long race ahead. But, and this is a big but, if your definition of strongest business growth is about explosive scale, market dominance, and the potential for astronomical returns, then West Africa is your champion. This is the land of giants. The sheer size of the population, the raw power of its consumer market, and the unrivaled depth of its fintech ecosystem are simply in a league of their own. West Africa is where you go to build a unicorn. It's a high-risk, high-reward arena that demands grit and agility. But the prize is capturing a market of over 420 million people. If you want to swing for the fences and have the firepower to navigate its complexities, West Africa offers a shot at glory that is unmatched anywhere else on the continent. So, who wins? East Africa wins on the scorecard of stability and real economy solutions. West Africa wins on the scorecard of scale and venture-backed firepower. It's a split decision. One region offers a smoother ride, the other offers a rocket ship. One is about building a resilient future, the other is about capturing the massive opportunities of today. Declaring a single winner would be missing the point entirely. The real story isn't about which region is better, but about understanding which region is better for what you are trying to build. And that leads us to the most important conclusion of all. Section 2, the real play, beyond East versus West. Here's the truth that you won't hear in most investor pitches or flashy headlines. The whole debate of East versus West Africa is becoming obsolete. It's a false choice. The founders, entrepreneurs, and investors who will truly win in Africa's next chapter won't be the ones who pick a side. They will be the ones who see the continent for what it is. A single, interconnected economic destiny. The future of African business is not East or West, it is East and West. The real winners will be the ones who learn to operate across both regions, leveraging the unique strengths of each. Think about it. The most ambitious companies are already doing this. A Kenyan agritech company, having perfected its model in the stable environment of East Africa, is now looking at the massive agricultural market in Nigeria. A Nigerian fintech giant, having achieved scale at home, is now expanding its payment services into the organized markets of Kenya and Rwanda. They are not limiting themselves to one block. They are building bridges, not walls. The smartest founders on the continent understand that true continental leadership means mastering the stability of the East and the scale of the West. It's the ultimate Pan-African playbook. For investors, this means the era of picking one regional champion is over. A truly diversified African portfolio needs exposure to both ecosystems. You need the potential for explosive fintech returns from West Africa to balance the steady, impactful growth from East Africa's climate tech and agritech sectors. Investing in only one region is like trying to fly a plane with only one wing. You might get off the ground, but you won't go very far, and the ride will be unnecessarily turbulent. The winning strategy is to build a portfolio that captures the full spectrum of opportunity the continent has to offer. So, the final verdict is this: the real winner is not a region. The real winner is the entrepreneur who thinks regionally from day one. The real winner is the investor who diversifies across both ecosystems. The East versus West showdown makes for a great debate, but the collaborative reality is where the real money and impact will be made. The next decade of African growth will be defined by those who can combine the discipline of Nairobi with the audacity of Lagos. That is the winning formula. That is the future. And it's happening right now.